Hi, Dave Armstrong here. It's the 15th of August, and welcome to my installment of Inversion Aversion. Okay. Yesterday I cut a video on the yield curve, got a lot of great compliments on it. Thank you very much for that. It really increases my confidence and makes me want to cut more of these. But I also got a lot of questions about, what exactly did I mean by distortion, and why a yield curve actually causes a recession. I'm going to talk about both those things. So there's an interesting. It's interesting to note that the current inversion process is different than what's happened in the past. Okay, so in the past we've had inflation, and we've had an overheating economy, and the Fed increasing short-term rates in order to slow the economy down. And as they're increasing the short-term rates, I got my sticky notes here. As they're increasing the short-term rates, right? The Fed is doing this. They're engineering increases in the short-term rates, causes an inversion, and inversions usually precede a recession, okay, or normally precede a recession. So this is based on Fed engineering, okay. Now, if what we're seeing now, here's what we're seeing now. We're seeing both the short-term and the long-term interest rates going down, not through Fed engineering, but through people coming in and buying the bonds. Now, here's something that you have to remember. I said this yesterday, but I'm going to use my stickies to explain it. There is an inverse relationship that takes place between bonds and their interest rates. When the price of a bond goes up, think supply and demand, as more people are demanding to buy U.S. bonds because there's negative interest rates globally and they want our bonds, right? Safest and best paying bonds in the world right now. They're coming in, they're buying them. And when the price of a bond gets pushed up, the yield comes down, the interest rate comes down. Inverse relationship. When bonds sell off, their interest rates go back up, okay? This happens, okay? Just take my word for it. Now, so if people are coming in and they're buying our bond and pushing the interest rates down because they're bidding the bond prices up, and they're buying both the long and the short end, both of these are going down because the prices are going up. What's happening now, though, is that as they're both going down, the long end is going down faster. More people are buying the long end than they are the short end because they're worried about the long-term prospects of the economy, the global economy. They're looking for long-term safety. Down, this one's going down faster. This is not being engineered by the Fed. This is not happening as a function of trying to stem an overheating economy or head off inflation, which is the Fed's mandate. This is market action that's taking place. And this is happening. That is a distortion. Okay, so over the past 7 times that we've had an inversion, okay, the short-term rates have been rising faster than the long-term rates because of Fed engineering, raising interest rates. Okay, this time around, they're both going down. Long-term's going down faster. That's also causing an inversion. Okay, it doesn't change the historical connotation of an inverted yield curve. I'm just explaining what I mean by a distortion based on people buying bonds versus the Fed engineering an inverted yield curve by raising short-term interest rates. Okay, two words I want everybody to be very, very careful about right now. There's a lot of people on TV right now saying that the yield curve predicts a recession. It's more accurate to say the yield curve inversion always precedes a recession, not necessarily predicts a recession. So be careful when you hear people on TV using these words. You want to be listening for the people who are talking about yield curves precede a recession. And the problem there, and I talked about this in yesterday's video, and we'll link that below, but preceding cannot give you an indication of when it's going to proceed. We could go into a recession tomorrow. We could go into a recession in 2 years, preceded by the inversion in the yield curve. We just don't know when. Okay, and I talked about that yesterday. Check yesterday's video out for a more in-depth discussion on that. But, the distortions in the behaviors driven by these short-term rates being higher than the long-term rates, I mean, those distortions and behaviors, I mean, they still apply. I'm just defining what's happening and why it's different now than it was in the past. That doesn't mean that the outcome won't be the same. I'm just explaining what I meant by a distortion. Okay, so I hope that clears that up. Second question I was getting a lot is, okay, why does a yield curve cause a recession? Okay, so I'm going to go back to my sticky notes here. I'm going to explain basically how banks make money. Okay, here's how a bank makes money. They lend money to people at longer terms and at the longer term interest rate. So they're loaning people money. people are paying the bank interest for borrowing the money, that makes the loan a liability on, I'm sorry, it makes the loan an asset on the bank's balance sheet. Okay. Then depositors come in and they deposit money with the bank, and the bank has to pay them interest in order to keep their money there. The bank uses the deposits to make the loans. They're making money here, they're paying money out here, and as long as that spread between those two things is positive, the bank is profitable. Okay, so these deposits are technically a liability to the bank, and that should probably make sense to everybody. Okay, so now what happens? Well, when the interest that they're receiving, when they make a loan, and the interest that they're going to receive on that new loan is lower than what they're paying their depositors, they lose money. So banks naturally become really adverse to loaning money because they're going to lose on it. That starts a credit crunch. Okay, when banks stop lending money because they are paying depositors more money than they're receiving in interest from the loans that they're making, starts a credit crunch, which basically is synonymous with a decreasing ability or appetite for banks to want to lend money. Once banks stop lending money, businesses now are impacted because they don't have the ability to afford people who are buying things from them credit to buy. Okay, and once credit dries up and the businesses are unable to afford to extend credit to the buyers, well, that's when downsizing starts happening. That's when layoffs start happening. That's when corporate profits go down because they're not selling anything because they can't extend credit to the people who are buying. Boom. That's what causes a recession. Okay. Now, here's what happens. The Fed comes in and they say, okay, well, we're going to re-engineer this thing, and we're going to, because we're inverted, we're going to start lowering the short-term interest rates by lowering the Fed funds rate, and we get a more normal shaped yield curve. Banks can now lend high, pay interest low. They have a profit on the spread. They start lending money again. When they start lending money again, businesses can extend credit. They start upsizing their business. They start rehiring people back. The stock market recovers. The economy recovers. Boom. There you go. So that's basically why an inversion in the yield curve is taken so seriously by people, because of the banking system and the availability of credit. So that's just quick explanation. You know, I still maintain that triggers haven't been met to classify this as a recession yet. That could change tomorrow. Okay, I just don't know. So when I know, I'll sound the alarm. But right now, I think, you know, it is what it is going on right now. We'll probably have a recession in the future. No one knows when, but for right now, I think everybody sits tight. Now, what does this mean for an investor? Okay, all this bullshit going on with the television and all of this stuff, this is traders and Wall Street stuff, okay? I'm assuming that I'm talking to people who are investors, okay? Here's how this impacts you. If you need cash in the next 12 to 18 months, you should raise it now. So what do you need cash for? You're going to buy a house. You're going to start retirement. Things like that. Think about things. If that applies to you, then you should be thinking about that right now, because it's possible that we are going to have a recession in the future, okay? Because yield curve inversions precede recessions, okay? If you don't need cash in the next 12 to 18 months, or you're not about to retire, or you're not about to buy a house or something like that, you know, you're probably okay just sitting tight and just seeing what happens. But ask yourself those questions. If you're not a client, call your financial advisor, talk to them about, you know, what your cash needs are. If you're one of our clients and we don't know about your cash need, something new has come up, please make sure you call us, let us know so we can start working on that with you. And of course, if you have any questions in general, let me know. You can always follow us on our social media stuff here. Check out some links to some of the videos I was mentioning below. You know, share, and also reach out and ask me any questions that you have. I am going to be out of the office until Tuesday morning, so I'll be up on email, but I won't be cutting any videos. So, all right, hope this is helpful. Reach out to me if it is or isn't, and I look forward to your feedback, and I'll catch up with you on the next video.